Economic value added then, actually what we call EVA, focuses on maximising shareholder wealth, okay? Now, what it also does, it encourages investments. Now, all of these things I want you to think about when we're going through it. It removes accounting distortions, and it is worked out as net operating profit. So operating profit is profit before interest and tax, but it's net operating profit after tax. So you have to work out your profit before interest and tax, and then you take the tax off. Now, it encourages investment because if you spend on things like advertising or some sort of research and development, then it says, look, don't treat that as an expense. Add that back, as you'll see. So it encourages investment. It removes accounting distortions. It gets rid of non-cash things like provisions and doubtful debts and goodwill amortized and that sort of thing. So you calculate your profit figure, then you take off your cost of capital, your weighted average cost of capital, times by what your net assets were at the start of the year. Because if you think about it, your net assets at the start of the year, that's what you've got in the business. You want to beat the cost of capital based on that. So if you do beat it with your net operating profit after tax, then you've done well. You've maximised shareholder wealth. Now, I appreciate, that's hard to take in when you're not looking at numbers, but let's keep on going. So that's the calculation. I want to focus in this video on the net operating profit after tax. As I said, you take your profit before interest and tax, which is your operating profit, but I need to take tax off that. So tax comes off that immediately, and then I do all my little adjustments like goodwill amortized. If there's been any, I'll add that back. That's just an accounting distortion. Research and development or advertising, they're not expenses, they're investments for the future. So I will add them back. Any provisions, again, like doubtful debts, if there's been an increase, that's an extra expense, but it's an accounting adjustment. So I'd add that back. A decrease, I would take it off. And depreciation is obviously a non-cash expense. So I'll add that back, but it does get replaced with economic depreciation. If it's not, just presume that it has been, okay? So that's how you work out the net operating profit after tax. Right, now let's focus on the next part of the equation, the WACC times by the net assets at the start of the year. So it's the net assets at the start of the year. It's that start of the year I want you to get into your heads. You take your net assets at the opening year value, okay? Just as an aside, if they give you replacement cost of the assets, use that. But you've also, remember when we was doing the NOPAT, we added back things like advertising and R&D. We added them back because they're not expenses, because they're actually capital. They're actually assets to us, aren't they? If you've advertised for the year, that should be bringing in benefit. So what you've got to do, you've got to, any assets that are capitalised, such as advertising and research and development, you add them back, but only if they were there for the start of the year. So it'd be the advertising from last year, really, that gets added in. If it's advertising this year, well, that will get into next year's calculations because it's the start of the year expenses that you capitalise. So, again, I appreciate that's all tricky. So let's go and have a look at a past exam question. So here we are in the September 22 specimen paper, and we're asked to do EVA, okay? And we get given these figures. So I open up my spreadsheet, and I say, right, okay, so I want to start off with operating profit, and that is 10,000. So far, so good. Then I add back, then I take off tax because it's operating profit after tax. I'm told tax is 22%, so in here, 22% times by that figure there, but I want it to be a negative, so I'll just put a negative in, done. Interest we ignore because it's net operating profit after tax, not after interest. And so that seems to be it so far. So I now go and have a look at the notes. It says during the year, 450,000 of advertising costs that will generate sales in future is in the income statement. So hopefully you recognise the advertising cost is actually a positive to us. So it's not an expense. I'm going to add back 450. Now, I'm not going to add that onto net assets at the start of the year because this happened during the year. So that won't be added on until next year's calculation. Doubtful debts is a provision, the next one. So doubtful debts provision was 300, which is a reduction of 200,000 from the beginning of the period. So doubtful debt provision has gone down by 200,000. Okay. And that's an adjustment I have to make. If a provision for expenses increases, I need to add that back. If it decreases, I take it off. Okay, and that's it. It looks like I'm done. So I'm just going to sum this up from there down to there. 8,050. Now I'm going to work out my net assets. So my net assets at the start of the year, he tells me here, look, was 88,944. Capital employed is the same as your net assets here. 88,944. Okay, I did add back though. I was making adjustments all the time to doubtful debts, and the doubtful debts at the end of the period was 300, that's at the end of the period. I see, which is a reduction of 200 from the beginning of the period. So the beginning of the period, we must have had doubtful debt adjustments of 500 that we've been adding back. Okay, so we've been creating more assets from. So I can now sum that up, or just have the two together really, isn't it? And now I can work out then, so my weighted average cost of capital given here is currently 9%. So EVA then would be the 8,050, but did that beat 9% of my net assets at the start of the year? Close my bracket. Yes, 0.04000. That's zero basically. Okay, so economic value added was absolutely nothing really, apart from a little bit of rounding.